Why did the rupee suddenly send a warning to the Indian investors? And why do currency movements sometimes reveal the economic stress before the stock market reacts? Because currencies often react earlier than the stock markets. When pressure builds in the global economy, the first signal often appears in the currency market. In the next few minutes, I will show you why the rupee is under pressure, how oil prices and global capital flows influence it, and why currency movements sometimes become an early warning signal for investors. Once you understand this mechanism, you will start seeing the macro risk before they appear in the stock charts. Most investors watch the stock market every day, but professional investors also watch something else very closely: the currency market. Currencies reflect the balance between the supply and demand for a country's money. And when global conditions change, currency markets often react faster than the stock market. But why would the rupee suddenly face the pressure? The answer begins with the global market. Because one of the biggest pressures on the rupee coming from something India depends on heavily: oil. India imports a large share of its energy need. When the oil prices rise, India needs more US dollars to buy the same amount of oil. That increases the demand for dollar, and when the dollar demand rises, the rupee tends to weaken. This relationship between oil and currency pressure is one of the reason global investors watch energy markets so carefully. But oil is only one part of the story, because the second force influencing currencies is the global capital. So global investors constantly move money between the countries. They compare the risk, return, and economic stability. When global uncertainty rises, capital often moves towards safer assets: US bonds, dollar assets, developed markets. And when global investors move money out of the emerging markets, their currencies can also face the pressure. But currency pressure can create another challenge for the economy, because a weaker currency does something very important: it increases the inflation risk. When the rupee weakens, imports become more expensive. Electronics, industrial materials, energy, and higher import costs can slowly push the inflation upward. When inflation risk increase, central banks must become cautious. They may delay the rate cuts or keep the interest rate higher for longer. And interest rate influence almost every part of the economy. But there is another place where currency movements start affecting the investors directly, and that place is the stock market. Currency weakness does not automatically cause the market crashes, but it can increase the volatility. Foreign investors may become cautious, imported input cost may rise for some companies, and sectors sensitive to global capital flows can react very quickly. But experienced investors understand something important: currency movements are not always a crisis signal. Sometimes they are simply early warnings. So, the real question investors should ask is this a temporary pressure or a structural pressure? There are three signals investors should monitor very closely. First, the global oil prices. Second, foreign investor capital flow. Third, inflation expectations inside the economy. If these pressure rise together, currency volatility can increase. But if the global conditions stabilize, currencies often recover very quickly. This is why macro investors watch the currency carefully, because sometimes currencies reveal the economic stress before the stock market reacts. Markets often move in layers. Currencies react first, then the bonds, and finally the stock, which means sometimes the earliest signal of change appears not in the stock market but in the currency market. So, the next time the rupee moves sharply, remember it might be telling a bigger story. And if you want to understand the global forces shaping the markets, subscribe to the channel, because here we decode how macro events quietly move your portfolio.